I think the main reason it hasn't taken off for remittances has been because stablecoins has filled that use case for now. Long term, however, I believe that due to the centralized nature of at least most stablecoins, they will be shut down from a regulatory point of view. You will be uncertain if your stablecoin suddenly gets seized or frozen. You can't do that if it's Bitcoin. The core value of Bitcoin being something you can hold yourself is something that the market will discover eventually. And when the infrastructure becomes smooth enough, it can take off as a payment instrument. And then the last phase would then be that we skip all the other currencies altogether and land on one universal global currency.
Okay, everybody, welcome again for a new episode of the Bitcoin Equities Talks. Today I'm with Torbjørn Jenssen, the founder and CEO of Arcario, and a very known figure in the cryptocurrency world. Perhaps, Torbjørn, you can present yourself and Arcario's business model and the history.
Absolutely, and really nice to be here. So Arcario is a publicly traded company on Nasdaq First North in Stockholm. We are an opportunistic investor in cryptocurrencies and the Web3 space. Before we became Arcario, we were known as Arcane Crypto. And Arcane Crypto, I founded together with some investors back in 2018, initially then as a private company. What we saw was that there was a lot of interesting things happening in the crypto sector. Remember, of course, that in 2018, there was a bear market. Prices were coming down. But at the same time, we saw the whole sector mature. We saw CME and CBOE had launched futures on Bitcoin. We saw Fidelity building out custody for Bitcoin. We saw Bitcoin getting its scaling solutions with Lightning being live. A lot happening on many fronts. And that made us very optimistic. And we wanted to kind of utilize that bear market to build a position. What we wanted to do was to build a portfolio spanning the value chain for financial services in the cryptocurrency space. When we looked at it, it looked very fragmented, especially compared to traditional finance. But also, we didn't want to put all our eggs in one basket initially. We wanted the value from diversification. So we spent like around 2 years building the initial portfolio, both through early stage investments and some acquisitions, started some business lines ourselves, and then we listed the company a few years later on Nasdaq.
So it was, just for me to understand, it was like a company that you set up to acquire or to take positions or participation equity holdings in other companies, yes. Right? Okay.
Yeah. And the thinking was then over time to consolidate that part that made sense to have together, keep a portfolio of businesses that we liked and wanted to be a part of for longer, and then spin off or shut down those ventures that didn't work out. The outcome of that is now Arario on the one hand, as the listed entity still, and then the operational businesses has been consolidated in what is K33. So we had a retail brokerage arm, we were running a hedge fund, and we've actually been mostly known for our market research. Those pieces we have brought together under one umbrella, under a K33 brand, and as one company, currently a subsidiary of Arcario. And K33 is mainly targeting kind of private wealth management. We're targeting high net worth individuals and family offices, offering them the services they need to engage with this industry, while also partnering and working with wealth managers and private banking institutions to give them the tools through K33 to offer exposure directly to their clients.
What sits today beneath Arcario, just K33, or you have your historical?
So K33 is the main asset in the Arcario portfolio. But we also hold a large stake in a very exciting project called LN Markets. They're building a derivatives platform on Bitcoin, leveraging Lightning Network. We hold a good stake in a Swiss-based tokenization project called FinPeers. We have a somewhat small mining operation running on renewable energy within heat capture in Norway, and a couple of other portfolio exposures in Arcario. So Arcario is this portfolio investment company, and we are continuing to seek out new investment opportunities. And then K33 is the operational kind of business unit where we unified the subsidiaries that we had and kind of put them under one strategic focus towards private wealth.
Okay, I see. And what about yourself? I mean, walk us through your background and history and what brought you to crypto. And you seem very focused also on Bitcoin, not only in crypto in general. So how do you balance between Web3, Bitcoin, and the whole digital space in general?
I guess to start with the last question, I have a team of people who have other areas of expertise, because personally, I'm kind of Bitcoin maximalist has become like a term that is tainted, because I'm not against other projects. I find a lot of what's happening on Ethereum, for instance, very interesting, but I'm very Bitcoin focused, and I see by far the most potential in Bitcoin. And I think, especially when it comes to the price for the token, I think a lot of people are mixing up the value for society from using one of these networks with the value the token will accrue. I think it's the demand for holding the token and the credibility of the limited supply, which is what will drive the price per unit. And there, Bitcoin has by far the strongest value proposition. Whereas all of these utility platforms, you can have a massive turnover. You can have a massive economy processed on those platforms. But the token itself doesn't need to have a high value. Actually, if the platform is successful, there needs to be very low frictions in using the platform, in paying the fees needed, which means that if you were to value a token based on its usage as a fee-paying medium, it would be very low, because I would take my local currency or like dollar or something. I buy the token and then spend it when I needed a transaction. But then it's sold again right after, so that it wouldn't have like a lasting impact on price. My leaning towards Bitcoin comes from when I first discovered cryptocurrencies or Bitcoin back in 2013, actually 2012. But at the time I was studying economics, and I had a very keen interest in the question of what is money. I was studying in London at SOAS, so I had teachers who had taught me the different schools of thought, not only the mainstream kind of take on what is money, but a lot of different schools of thought on what is money, what does it mean, how does it like interfere like with power, like the state power, the power of the market. I found like that to be super fascinating. And then a friend of mine pitched, well, why don't you buy Bitcoin? Like I think the price was around $60 or something. I didn't buy it, but I invested all my time in researching it, and I ended up doing my master thesis on Bitcoin. And doing so, I fell into the rabbit hole. I really realized that this was much, much bigger than what I first thought. What fascinated me the most was the fact that it enabled both kind of permissionless innovation, permissionless participation. So anyone could build a new application. Anyone could leverage Bitcoin the way they wanted to. And anyone could kind of participate. So for me, that's the main engine for innovation. That will make it like, even though the services are really bad now, and especially then, the fact that anyone can try means that evolutionary, it'll be superior to anything the traditional financial system can come up with, because that's creationism. That is innovation by design and approval by committee. It's like, it's not going to go anywhere. It's too slow. So that was like super exciting to me. In addition, studying economics, and also I was very focused on the cost of doing remittances, I realized how unique it was that Bitcoin was the digital bearer asset. The fact that if you hold a Bitcoin, like holding a gold bar, no one owes you anything. And that means that it's a great medium for cross-border payments, because the challenge in cross-border payments is that you take a claim on your bank, and you want to move that across jurisdictions. But claims are inherently linked to a jurisdiction. I mean, it's in the nature of it being a claim. That's the core friction point, making it expensive with cross-border payments today. The fact that you have to go through the correspondent banking system where banks in a chain can exchange claim on each other, so that in the end, your receiver have a claim on his local bank or his local financial provider. Whereas with Bitcoin, since it's claimless, I can take my local currency, buy Bitcoin, send that to South Africa or the US or to South Korea. And the receiver can take those Bitcoins and sell it to their local currency, and you have final settlement. And there's no, like the fact that it can happen on a Sunday, the fact that it can happen immediately, is not because it's unsettled credit and a fintech company is willing to credit a balance in your app. It's actually final settlement. And to me, that is absolutely kind of transformative for how we can do business. It hasn't kind of played out in full yet. My main focus in the master thesis was on how this could help cut costs for remittances. So far, it hasn't taken off in a grand scale for remittances. And the reason has been that you need good on and off ramps. You need simple marketplaces to exchange in and out. You need good liquidity. And that has taken a decade or so to build up. But we're getting there.
Okay, I mean, it's interesting that very early on you saw all this. I mean, I discovered Bitcoin more or less around the same time, but I didn't think about it in terms of the economics and what is money, etc. For me, it was more a unique currency that we can all commonly share and stop paying all these Forex fees. Because having worked myself in the financial market for 10 years, I mean, the Forex market is one of the most liquid market on earth. And yet, when you land in any country that has a different currency than yours and you go to the local airport Forex exchange desk, you get just killed. So the reason why the spreads are so wide is because of a kind of monopoly held by the banks and the Forex intermediaries that keep the margins wide to make the most money out of all the people that are exchanging these currencies from one currency to the other. And
yeah, I think you're spot on the monopoly part, or at least lack of competition, right? Because like the underlying market is extremely tight and efficient, but very few people choose their bank, and then like they look at the interest rate on their mortgage, and they look at the payment services they can have locally, and they forget about the cost when they go traveling. And then when you do go traveling, it's the bank that screws you. Like they didn't have to charge like 100 basis points to let you, or even way more, like 400 or 500 basis points to let you exchange into another currency. It's solely a decision they're making because they can, and they also get away with it because you don't see it that easily. Because you're thinking in a local currency at home, and then it's another pricing there, and most people would use like pretty round rules of thumb when they calculate this. Also for companies, when they pay, there is not a cost item in their financial reporting that says extra cost due to inefficiently high FX. So it's hidden as if what you imported or like bought was more costly. You don't see the FX cost as an explicit cost, which means that it's not easily identifiable as something to kind of address and then push your bank on. And I think what's fascinating is like, because there's a lot of people who hope that long term Bitcoin can be this like universal currency, like the Keynesian idea of a bancor, like the world currency. Personally, I think, at least before we get there, I think what it does is that it drives competition into the mix, but we still keep our local currency. So you'll actually have more exchange steps. But what we see already is that the price, like if you exchange with our brokerage from Norwegian kroner to Bitcoin and to dollar, you'll have way lower cost than if you went straight to dollar with your bank. And I think it brings competition to the cross-border payment space and also on the retail front.
Yeah, and especially on the business side of things, like you were saying, even if you're trading high volumes, you're still like for the same volume and the transaction fee that you're paying on Forex, even if you're like a big exporter or importer or whatever, you still have like a much wider spread that you're paying on exchanging currencies versus the liquidity basically that you're supposed to be having and the spreads that you're supposed to be having if the real liquidity of the market was shown to you directly. And there's a lot of businesses that specialize in arranging B2B transactions with big companies that do this type of products. But so you mentioned also remittances and the lack of pickup there. Being Lebanese myself and coming from a country that lost its currency, or at least like people complain that Bitcoin is volatile, they should see the Lebanese lira is like twice the volatility of Bitcoin. But yet people struggle to accept it because in most of these developed countries, their benchmark or they look up to the Western countries. So if everybody was accepting Bitcoin in the US and in Europe, and you could pay in any store or any marketplace in Bitcoin, then the adoption will come in the developed countries. So it's a kind of chicken and egg solution or problem where you want them to adopt it, but they're looking at the sender's part and they want the sender to adopt it. So how do you see it unraveling?
So I think it goes in different phases. So I think the first and important phase is the financialization, where it becomes an investment that you hold in the expectation of future appreciation. And that's the phase that we're currently in. People are buying Bitcoin to hold it because they hope it'll appreciate. This activity, of course, also drives in traders and helps improve the liquidity for Bitcoin over time. It improves the liquidity. Since this is also happening all around the world, it improves the liquidity between local currencies and Bitcoin. Now we're getting regulation of this market. For instance, here in Europe with the MiCA regulatory framework, we have had some bad players being washed out last year. There's probably going to be some new bad players washed out later. But what we're seeing is that we get more and more established setups so that people can comfortably exchange in and out of this otherwise instrument they use only for trading. The buy side effect of this is that eventually the cost of going from your local currency into Bitcoin and out again becomes so low that it becomes almost like a free option to add payment capabilities in terminals. So you can charge a little bit more on a payment that happens in Bitcoin than, say, dollars, or you don't have to pay the same fee. So like the merchant can make a little bit more, and then you'll get the incentive for adding support for payments. Initially, it'll be driven by those who seek to tap into wealthy Bitcoiners' pockets. They want to sell them something that Bitcoiners might want to spend money on, and as a marketing tool, allowing them to spend directly from their Bitcoin will be kind of drawing their attention more than if you have to sell your Bitcoin and then use fiat currency. But then over time, the questions of how do you regulate, how do you keep track of the payments, how do you comply with the local regulation will get sorted. So you'll have a setup where every merchant will eventually, I think, accept Bitcoin, not because they themselves want to hold Bitcoin, but because they seamlessly can get their preferred fiat currency. But like in that theoretic example where eventually everyone can accept Bitcoin because they can have an instantaneous exchange into their preferred currency, it means that anyone can also pay their supplier in Bitcoin. And then that's when things gets really interesting. That's when you really will start seeing companies holding an inventory of Bitcoin because they know that they will paying someone later and they will save on some of the exchange costs. And especially, I mean, there are already people using Bitcoin for cross-border transfers. And I think the main reason it hasn't taken off for remittances has been because stablecoins has filled that use case for now. Stablecoins have taken off. Long term, however, I believe that due to the centralized nature of at least most stablecoins, they will be shut down from a regulatory point of view. You will be uncertain if your stablecoin suddenly gets seized or frozen. You can't do that if it's Bitcoin. So like the use case of like the core value of Bitcoin being something you can hold yourself is something that the market will discover eventually. And when the infrastructure becomes smooth enough, it can take off as a payment instrument. And then the last phase would then be that we skip all the other currencies altogether and land on one universal global currency. I think it's highly uncertain if we'll get there. But I think the most interesting thing is to look at these phases and realize that, well, it doesn't make sense to talk about the later stages unless we progress from where we are now. So the thing to pay attention to is, are we progressing? Is liquidity becoming better? Yes, it is. Is it easier to go from local currency to Bitcoin and back again? Yes, it's getting easier. It's getting easier at a slower rate than we would have hoped, but it's still moving in that direction. So this is probably like a multi-decade type process. Most of the appreciation will come from Wall Street, ironically, kind of, given where Bitcoin was kind of created as anti-Wall Street initially. But the appreciation will come from Wall Street binging on this as an investment. You'll get this rule of thumb of having, like, say, 2%, 4% in a well-diversified portfolio. It's uncorrelated. It's a great diversifier. Backwards looking, like a small allocation to Bitcoin would have substantially increased the Sharpe ratio of your, say, a 60-40 allocation. All of this will become institutionalized, and it's a requirement, I think, for the more kind of payment use cases to really take off mainstream in the future.
Yeah, actually, you raised so many topics now. I just want to pick one of them that it's the first time I hear it, actually, and I find it quite interesting, is that you see Bitcoin as the network in practical as a mean for in the future merchants to use it to exchange from one currency to the other, beating the traditional financial system, because you're operating on a decentralized network without cross-border hurdles and intermediaries. This I find it quite fascinating. I want to pick your brain around stable coins. So you mentioned that they will come under regulatory pressure and they will be shut down. I do share your view on this one, but at the same time, I'm quite mesmerized by the fact that for the past couple of years, we have seen regulation stepping up. But at the same time, the least regulated stablecoin, which is Tether, has been growing in market share. And the ones that are regulated, like USDC, have been losing market share. How do you see that evolving in the future?
So I think, so first of all, I'm surprised how long regulators has kind of allowed stable coins to be so loosely regulated. And I think the main aspect I'm thinking of is on KYC requirements, because right now how it works is that if you're the first entity to which they issue a stablecoin, they check you, then they let the stablecoin live and be owned by whomever in between. And then if you redeem it for a bank deposit, they check you. You could easily do this with PayPal. And actually, back in the days, PayPal was run this way. You could have a PayPal account without KYC. But then eventually regulators said, well, actually, you need to know every person, like at every point in time, like full surveillance. So I've thought for a long time that would have come. It's still not something that even USDC is required to, as far as I understand it. So that's surprising to me. When it comes to then Tether versus USDC, I think there's a couple of things that is important to be aware of. One is that they are much more similar than people like to pitch them as, and especially USDC try to pitch themselves as more regulated or kind of with a more thorough backing or something, but they're very similar in the setup. That said, I think trying to be US regulated is probably blocking USDC from getting real organic adoption. Tether's ability to be more nimble, more flexible, more adaptable, I believe is a part of the reason why it's organically seeing real demand, whereas you see USDC, Circle has been trying to force adoption of USDC. They've tried to subsidize and incentivize entities to hold USDC. They haven't been able to really tap into the same level of organic demand as USDT. And I think, if you're doing trading between, say, Russia and China, and you use USDT to facilitate that, if you're living in Turkey and you rely on USDT, if you're working or participating in the gambling industry and you use USDT when you're in tournaments and meeting people internationally, and then someone say, hey, look, why don't you switch to USDC? Like, then what's the value proposition? First of all, you have a stablecoin that already everyone accepts. And you feel like, well, it's probably a little less kind of regulated, but it's also kind of what you're looking for. It's kind of that flexibility. Then USDC feels a bit like, oh, well, Tether also has to answer to US regulators, obviously, and they kind of have been in a lot of process there. But with USDC, you would probably feel a bit more uncertain in the risk of your funds being frozen for political reasons. This is just, I don't have too much first-hand experience with this, actually none, but this is how I read it. I think it's easy to buy the pitch without thinking that, oh, more regulated should be more adopted. Whereas if you ask yourself, what is the problem they're really trying to solve? If you want regulated, use bank deposit. Okay. So what is it? It is actually regulatory arbitrage. It's being somewhat unregulated and somewhat flexible, which is the value prop.
Okay, I want to jump to the next topic, which is Ethereum. So you mentioned that you have seen a lot of projects and a lot of excitement on Ethereum. I do share the interest also on this technology and on all other blockchains. However, I find that for the same reason as for stablecoins, much harder regulatory risks when it comes to adding on top of a blockchain other contracts than just payment or moving value. Because in any contract, when you add a smart contract or any condition to the contract, if then do, etc., it becomes a derivative and therefore a financial product, or it can be reclaimed by the regulator as a financial product or a disguised financial product or interpreted in that way. And therefore, you fall into all the historical and existing financial regulation, which makes banks and the traditional financial system so inefficient, but at the same time so safe to protect the people involved in these forms of exchanges. How do you see these other blockchains thriving in a regulatory environment constrained by regulator, as we have been seeing in the past years?
So personally, I don't think regulation is the main blocker, and definitely not in practice, because you see, there are some projects here and there that get fined for having had unregistered securities, according to US regulation. But overall, there's just so many even clearly financial products that just keep building, that are allowed to exist, or they figure ways to exist. So the regulators doesn't have the capacity to really keep up with this. They barely keep up with the largest tokens and the largest players, so they have enough on their hands. My main worry is that almost all the use cases we've seen so far has been basically enabling more gambling. in the form of more leverage, unregulated leverage for retail, which means that the whole ecosystem has to a large degree evolved by crypto for crypto. There's no, or very limited, real world integration. So-called decentralized finance, there's no one who's making taking up a mortgage. There's no one who's actually buying an insurance. It has become like a pure kind of trading marketplace for, like, doesn't matter what the ticker is, you just like trade these tokens almost kind of completely detached from the real economy, which on the one hand can act as an accelerator of these technologies. You run into a lot of bugs, you iron them out, some people lose a ton of money, you launch a new version, and you have very high-paced innovation. And then the hope could be that eventually these will mature to such a degree that they will enable real-world use cases. On the other hand, if you question what's kind of really being solved here, and I think it is like one of the core things is decentralization, making it censorship resistant. And that is true for Bitcoin. That is not true for many other projects out there. And the more complex they get, the more computational intense or data intense they get, the more centralized they tend to be and or force the blockchain to be. And if you're sacrificing the decentralization, what you're left with is, which is still very interesting, is composability, interoperability, that these protocols can speak to each other. But I think it's very important then to remember that they are then not fully decentralized, which then, of course, triggers your point, I guess, long term, means that they are much more easily regulated. There's a kind of a point to put pressure on. But yeah, I don't know. It's I find it interesting because there's so much technology being developed. I think a lot happening around rollups are very interesting. I think, especially with an economics background, I think Maker and the way it's basically replicating how banks and together them in a monetary board actually do lending, credit creation is very fascinating. And the fact that it's been surviving in this very volatile market is very fascinating. But to me, it's still very much like a playground. It's not at all something that I would kind of deeply build into the infrastructure of something I would want to last really, really long. I think the Bitcoin philosophy, where you try to keep the core blockchain much more simple, and then you add complexity, higher levels in the stack, to me makes more sense. I would build my house on bedrock, not on unicorns and and
yeah, I see what you mean.
Fast break things.
Yeah. So what do you at K33 advise your clients to do?
So that really depends on client to client. The main thing we're doing is that we help clients facilitate what they themselves want, and we help them navigate what is happening, understand the market structure, understand what to expect short term, long term. Those who seek advice, we advise being conservative. We advise that they start building some exposure to Bitcoin, and then we discuss with them and explore in what type of packetization, whether that is self-custody, custodying in a vault with kind of bespoke withdrawal rules and kind of on-chain monitoring of their assets, and whether it's through other instruments being ETPs or traded products, whether they mainly need the financial exposure or they actually want kind of the real thing. So I think we're not giving strong advice as much as we are aiding and assisting in clients' demands and wants.
So you're answering clients' demands rather than pushing your own convictions or your own strong use cases, basically.
Yeah, but what we do push is caution. So a lot of the research you would find on different projects, for instance, out there, is often written as if the project themselves had written it. It's written as a polished presentation of the pitch of blockchain XYZ. We're trying to be more critical, not because that we want to, and even also towards kind of Bitcoin, but like we want to be more honest. So if there are structural weaknesses, if there is a token that's getting a lot of attention, but there's no economic linkage to the usage and the token value, we try to help make our readers of the research and our clients aware. If they still want to buy it, that's fine. And I mean, some of our clients want to trade narratives. We have like a weekly newsletter called Navigating Narratives, which is only looking at kind of mid-cap, low-cap trading opportunities. But we try to be with them very honest on what it is and what it isn't. What it is now, maybe it can become something else, but I think what is important to us is that our clients clearly understand what they're getting into, and then we trust them to make their own informed decisions on the basis of that.
Okay, so you are heavy on the research and you're positioning yourself as an independent research of the whole crypto ecosystem, right?
Yeah, so the research arm are free to write exactly what they believe is the right insights, and there's no, cross-selling with the brokerage or the management side.
Okay, so you have the research side, you have the brokerage side where you execute or you help them execute their ideal portfolio. What else do you have?
Yeah, so then we have on the investment side, we currently run a hedge fund, which mainly offering, you could think of it as a actively managed smart beta. In many ways, it's a conservative allocation, but we're, in addition to holding a large position in Bitcoin and in Ether, we're finding other projects that we have long-term fundamental belief in, or the fund manager sees strong potential in, and then actively size up and down in that portfolio. On a similar mandate, but a smaller universe and a different kind of mandate, we have actually launched an index. We haven't launched a financial product yet, but we have a kind of formal reference index, the KVQ index, the K33 Winter Quality Index, which is top 30 tokens. And then we have 5 different pillars for assessing the quality, and then we're removing those that don't pass the test. So you can view it as a top 30 quality filtered. That doesn't mean that we endorse all of those that make it, but at least we have taken out those that have some severe lackings.
So it's a discretionary index, or there's a methodology behind it?
There is a systematic methodology, but it's discretionary in the sense that it's not automatically kind of derived from some quantity metrics. But it's a very thorough methodology, and which is also public, and kind of we follow the methodology. But at the end, it's kind of discretionary assessments on the different pillars. But once the valuation for each pillar has been set for each token, then the rest of the selection follows automatically.
When you talk about the hedge fund part, it's like you're long tokens, or you go long, short, and you have different strategies, high frequency, low frequency.
So that's low frequency, mainly fundamental, absolutely mainly long. I mean, at least 80% of fund will always be fundamentally and long allocated. We can use up to 20% of the AM opportunistically for shorter term trades. We have been short some small allocations from time to time. What we are now extending to is actually using options more, and that's more to hedge downside. Typically, when you see the market getting very frothy, buying put options, for instance, can be very cheap and a very good opportunity, because the markets will repeat when it gets frothy enough. So, but it's mainly a long fund, fully discretionary, and long exposure. So for the fund, it's for professional investors only, and We advise for at least a 3-year investment horizon. It's open-ended. So we are investing in liquid projects and avoiding kind of illiquid projects. But the investors should themselves make up their mind, with the help of our research if they like, but whether they want to get long the market or not. And if they want more than just Bitcoin, but don't have the time to really pay attention day in and day out and figuring out what is crap, what is good, should I have more Bitcoin now, less Bitcoin, ETH? Okay, if the spot ETF gets approved in the US in January, what will happen to ETH after? If they don't have the time for that, we'll take care of that. And if their CFO wants something that they are used to dealing with, this is a structure for them.
Okay, I see. Interesting. Okay, so we covered Arcario, we covered the K33. What else are you doing?
Well, I'm doing podcasts. No, I think in the Arcario portfolio, those are the main two pieces, right? And then personally, I try to participate in public discussions. I try to go to conferences. Of course, that's beneficial to the company on the one hand being present, but I think personally, I also want to help spread education and understanding. I don't want to be seen as a Bitcoin evangelist. I'm very optimistic on what it can bring to society. I'm very well aware of all the negatives, but I really want to help spread awareness and understanding. And my goal is not that people should be bullish or bearish, but rather that they should realize that it's here to stay. The momentum has been building so much, it's unlikely it'll stop now or plateau now even. So people should really start taking it seriously and ask themselves, how can we get the most benefit from this in my industry, in my personal life, in society? So that's something I spend quite a lot of time on myself. And of course, I have 2 kids and family, and with a 24/7 market, that fills up most of my time.
Okay, perfect. I think we have a wrap. Thanks a lot for your time and sharing your thoughts and views on the whole market. And I look forward to see you on the podcast once you have another news or another venture coming in.
Yeah, thank you so much.